Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over FAR Area 3, this is Section F, and this is an application topic. Calculate the lease costs that a lessee should recognize in the income statement. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. We will teach you the key ingredients to passing the CPA exam in 1 hour for free, so that you don't waste months or even years of your time failing these exams. And after you watch that, you're going to want to learn more, so make sure you check out the Superfast CPA Pro course. If you become a Superfast CPA Pro member, you get access to the Pro course, which is where Nate explains in detail exactly what you're supposed to be doing every day to pass the exams, but also Superfast CPA Pro members get access to the full 10-question versions of these 5-question YouTube videos. So if you like these 5-question YouTube videos, just know that Superfast CPA Pro members get access to the full 10-question videos where I go over more questions so that they can get a little bit more practice and a little bit more understanding. So again, if you like this, make sure you check out the webinar, make sure you check out becoming a pro member, and with all that, let's dive straight into the questions. All right, here we are at question 1, and something I always like to point out with these questions is you always want to read the last part of the question first. This will give you context for what the question is even talking about, so that as you read through the rest of the question, you actually know what you're looking for, and this will save you time on test day. I've said this before, but it might feel a little bit like a waste of time to be doing this during your normal studying, but I promise it is a good habit to get into because when you get to test day, you have no idea what you're going to be seeing, so you want to make sure that you can understand what you're supposed to be doing for a question as quickly as possible. So again, read the last part of the question first, and that will give you context for what the question is talking about. So let's go ahead and do that. What amount of amortization should the company recognize for the ROU asset in the income statement for year 1? Okay, let's go up to the top. A company enters into a finance lease on January 1st, year 1, for a piece of machinery. The lease term is 6 years with annual payments of $50,000 due at the beginning of each year. The company has the option to purchase the machinery at the end of the lease term for a bargain purchase price of $5,000. The machinery has an estimated useful life of 10 years. The implicit interest rate in the lease is 6% and the present value of the lease payments is $260,000, which equals the fair value of the machine. The company uses the straight line method to amortize the right of use asset. So again, with all that information, we know that we need to calculate the amortization for the ROU asset in year 1. And if you have no idea how to do this, that's okay. One thing I will say, if this is the first video you're watching for Superfast CPA, or this is the first video you're watching for leases, I would recommend going and watching the previous 2 videos that I made in the past couple weeks, where I talk about how to classify a lease as a finance or an operating lease. And then in the last video, we talked about how to calculate the lease liability and the ROU asset on the balance sheet. And I think that those videos will be very helpful in helping you understand what is going on in this video. So I would recommend going and watching those if you haven't already watched them. But again, we are figuring out the amortization for this right of use asset. So if you don't know how to do it, that's okay. If you do, if you want to take a guess, go ahead and pause the video. And when you're ready to come back, we will look at the answer together. All right, here we are. The answer is A, $26,000. It's a pretty simple calculation, so let's walk through it. Since the lease includes a bargain purchase option, and again, we talked about that in the previous videos, basically that is where a company is able to purchase the asset that they've been using for a very low amount, like it's lower than the fair market value, so it's a bargain purchase. So if there's a bargain purchase option, and a lot of times this is written as a written purchase option, or written purchase agreement, the ROU asset is amortized over the useful life of the machinery, 10 years, not the lease term. So again, just to reiterate that, because this has a bargain purchase option, and that's why it's a finance lease, you actually use the useful life of the machinery instead of the lease term when you are calculating the right of use asset amortization. So that makes it pretty easy. $260,000 of the present value of the lease payments, divide that by the 10 years, and that gives you $26,000 of the right of use asset amortization for the next 10 years. So that's a pretty simple calculation right there. Biggest thing you need to remember there is pay attention to why it's a finance lease. If it's a finance lease because it transfers ownership at the end, or because there's a bargain purchase option or a written purchase agreement, that's kind of the same thing, then you use the useful life instead of the lease term. But other than that, you would use the lease term to calculate the right of use asset amortization. With all that, let's go to the next question. All right, here we are at question 2. What is the amortization expense for the leasehold improvements for year 1? So let's go up to the top. On January 1st, year 1, Modern Fitness Center installed leasehold improvements, including new flooring and wall partitions, at a total cost of $90,000. The improvements have an estimated useful life of 12 years. The lease on the center has 5 years remaining with an option to renew for an additional 3 years. However, the renewal option is not reasonably certain to be exercised. So they're not really sure if they're going to renew that or not. So again, with all that information, what is the amortization expense for the leasehold improvements for year 1? If you don't know how to do this, that's okay. That's the whole point of these questions. We're learning how to do these from the questions. But if you want to give it a try, go ahead and pause the video, and when you're ready, come back. We will look at it together. All right, here we are. The answer is A, $18,000. That's the amount of amortization for the leasehold improvements in this year. So let's go ahead and go through this. Leasehold improvements are amortized over the shorter of their useful life or the remaining lease term, unless the renewal option is reasonably certain to be exercised. So you would, take that into consideration if it was going to be used. However, in this scenario, the useful life of the improvements is 12 years, but the remaining lease term is only 5 years, and the renewal option is not reasonably certain to be exercised. Therefore, the improvements are amortized over the 5-year lease term. So the $90,000 of improvements, you amortize it over 5 years, not over 12 years, and that gives you $18,000 of amortization each year. So again, another thing you need to remember for this, for leasehold improvements, you amortize them over the remaining life of the lease or the useful life of the leasehold improvements, whichever is lesser. So if, for example, in this case, if the leasehold improvements only had a useful life of 3 years, then we would actually use that for the amortization instead of the 5-year lease term. But, that was just an example. So that's how you do leasehold improvement amortization. Let's go to the next question. All right, here we are at question 3. What is the monthly lease expense that Pinewood Art Supplies should recognize over the life of the lease? So let's go up to the top. Pinewood Art Supplies signs an operating lease for a retail space with a 36-month lease term. The lease agreement requires monthly payments of $5,000, but as part of a lease incentive, the landlord waived the first 3 months of payments. So they don't have to pay their lease rent or lease expense for 3 months. So with that knowledge, what is the monthly lease expense that Pinewood Art Supplies should recognize over the life of the lease? So this is something new. Again, if you don't know how to do this, that's okay. We're going to look at the answer. But if you want to give this a try, pause the video, do it on your own, and when you're ready, come back. We will look at it together. All right, here we are. The answer is A, $4,583. That is the amount of monthly lease expense that is going to be recognized over the course of this lease. So let's go through this. Under an operating lease, the total lease payments are spread evenly over the lease term, regardless of any incentives or periods where no payments are required. So what that means is you pay the same amount every month for the lease term, regardless of the incentives. So what does that mean? That means that we're going to do the following. First, you have to calculate the actual amount that they're paying over the course of the lease. So even though the monthly lease payment is $5,000 and the lease term is 36 months, they're actually only paying the amount of 33 months. So $5,000 multiplied by 33 months, because again, there's 3 months that they're not going to have to pay any money. So 33 months multiplied by $5,000 is $165,000. That's how much they're going to be paying over the life of the lease. But the lease term is still 36 months. It's not 33 months. It's still 36 months. The incentive was just that they don't have to pay for 3 months, but the lease term is still 36 months. So we divide the $165,000 of the total lease payments by the 36 months, which is the full lease term, and that gives you $4,583. That's the amount of lease expense they're going to recognize every month over the course of the lease, because we take into account those incentives, and that actually changes the amount of the lease expense that we are going to recognize over the course of the lease. So we're actually going to be recognizing a $4,583 monthly lease expense, but the monthly lease payment is actually $5,000, but this is what we're actually going to be recognizing as an expense because of those incentives. So that's how you take into account incentives when it comes to a lease, and this was an operating lease. Now let's go to the next question. All right, here we are at question 4. What is the interest expense Tech Innovations Company should report for year 1? On January 1st, year 1, Tech Innovations Co. enters into a finance lease for equipment. The lease agreement requires annual payments of $50,000 for 5 years, with the first payment due on December 31st, year 1. The implicit interest rate in the lease is 6%. The present value of an ordinary annuity factor for 5 years at 6% is 4.2124. So again, with all that information, we have to figure out what the interest expense is for this first year of the lease. Now, again, this is a question that I think you will have benefited from watching the previous 2 videos, because we've gone over things similar to this in those videos. So if you haven't watched those, you might not really know how to do this. If you don't know how to do it, that's okay. We're going to go to the answer in just a second here. But if you did watch those videos, try to remember how we calculated all this in the previous videos, and then come back when you're ready. All right, here we are. The answer is B, $12,637. That is the amount that they're going to recognize as interest in year 1. So let's go ahead and go through this. First, we have to calculate the present value of the lease payments. So we have to figure out what the total lease liability is at the beginning of the lease. So we take the annual payments of $50,000 multiplied by the present value factor that we were given, and that was 4.2124, and that gives us $210,620. That is the amount of the lease payments, or the present value of the lease payments, based on the present value factor. So now that we know that, we can figure out the interest expense for the year. One thing I want to point out, and again, we've talked about this in the previous video, since no payments are made until the end of the year, the entire present value represents the outstanding liability for calculating interest. If they had made their first payment at the beginning of the year, like at the same time they started the lease, then things might be a little bit different. And again, we talked about that in the previous video, but since they made it at the end of the year, then they had an entire year of interest that built up. So how do we calculate the interest? It's pretty simple. We take that liability that we calculated of $210,620, multiply that by the 6% implicit interest rate, and that gives us $12,637 of interest expense. Now, there's a bit more to this if you watched the previous video, but that's all we needed to do for this question. We just had to figure out what the interest expense was for year one. So that's how you calculate that. Now let's go to the next question. All right, here we are at question 5. What is the annual amortization expense for the right of use asset? So this is another right of use asset amortization question. So let's go to the top. On January 1st, year 1, SolarTech Inc. enters into a lease for specialized equipment. The lease term is 8 years and the equipment's estimated useful life is 10 years. The lease agreement requires annual payments of $40,000 with the first payment due at the end of year 1. The implicit interest rate in the lease is 6%, and the present value of an ordinary annuity factor for 8 years at 6% is 6.2098. So with all that information, what is the annual amortization for the right of use asset? So again, this is similar to what we did in question 1, but a little bit different information. And remember the rules that we've learned so far. I think you should pause this video, try this on your own, and when you're ready, come back. We will look at the answer together. All right, here we are. The answer is B, $31,049. That is the amount of annual amortization expense. So just in case that got you a little bit confused, again, this is the annual amortization that we're calculating. We're not calculating like a monthly amortization or anything like that. So let's go to the explanation. This lease qualifies as a finance lease. So that wasn't explicitly stated. And again, that's where the previous videos would have come in handy. You would have been able to pick out what kind of lease this was. Again, this is a finance lease because the lease term is 8 years, and that is equal to or greater than 75% of the useful life, which is 10 years. It's 80% of the useful life. So when a lease, it has more than 75% of the useful life as the lease term, then it's a finance lease. However, since there was no written purchase option or ownership transfer, the amortization period is the lease term, not the asset's useful life. So in question 1, we used the asset's useful life because there was a written purchase agreement. It was a bargain purchase option. But in this case, that is not the case. It's still a finance lease though, so we still have to calculate the right of use asset and all those things, but we're only going to be using the lease term, not the useful life. So let's walk through this. It's pretty simple. We take the annual payments of $40,000, multiplied by the present value factor that we were given of 6.2098, and that gives us $248,392 as the present value of the minimum lease payments, and that is going to be the lease liability and the right of use asset at the beginning of the lease. So that's what we initially record. Now we can calculate the annual amortization for the right of use asset. And again, we use the lease term in this case because it doesn't have a bargain purchase option or transfer ownership. So $248,392 divided by 8 years, which is the lease term, and that gives us $31,049 of annual amortization for the right of use asset for this lease. So not too difficult. The main rule, again, you need to remember is that if it's a finance lease, is that you need to pay attention to why it's a finance lease. If it's a finance lease because it transfers ownership or there's a written purchase option that's going to be used, again, that's called a bargain purchase option frequently. If those are present and that's why it's the finance lease, then you use the useful life of the asset rather than the lease term to calculate the right of use asset amortization. But if that is not the reason that it's a finance lease, if those are not present, then you do use the lease term to calculate the right of use asset amortization for each year. And with all that, we've learned a lot in just 5 questions. Before we do anything else, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. Again, these are the important things, the pillar topics that you see throughout the questions. You've seen 3 or 4 questions trying to teach you how to calculate the amortization for a right of use asset. You've seen 3 or 4 questions trying to teach you how incentives work when it comes to calculating the actual monthly lease expense or, whatever the case may be. You notice these things throughout the questions. These are the things that you see more than once, and you write them out in your own words. Again, these are the most important things you learned. And as you do this each day, you will be building your own personal repository in your own words of what is most important, what you need to know for the exam, and that will help you be ready for test day. Let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics. Let's go ahead and just go through them. The first pillar topic is about calculating amortization expense for an ROU asset. To calculate the amortization expense for a right of use asset, use the lease term unless the lease includes a written purchase option or ownership transfers, in which case the useful life of the asset is used. And again, it's not too difficult besides that. You just take the amount that you calculated based off of the present value of the minimum lease payments, and that is the right of use asset most of the time, and you divide that by either the lease term or the useful life, and that gives you the annual amortization for that right-of-use asset. Now let's talk about amortization for leasehold improvements. Leasehold improvements are amortized over the shorter of the lease term or the asset's useful life, unless the lease is reasonably certain to be renewed. So if that is the case, then you have to take that into consideration. Again, not too difficult, you just need to know the rules. Next, let's talk about lease incentives and monthly lease expenses. Lease incentives, such as waived or reduced payments, must be taken into account when calculating total lease payments and evenly spread over the entire lease term to determine the monthly lease expense. Basically, in other words, you have to calculate the total lease payments, and that takes into account any discounts or anything like that, and that's what you divide by the total life of the lease, not by, any discount or anything like that. You divide it by the total life of the lease, and that will give you the actual amount of lease payments expense that there will be each month. So it could be different than what is stated at the beginning of the lease. Now let's talk about calculating finance lease interest expense. To calculate interest expense for a finance lease, first you have to determine the present value of the lease payments and then apply the implicit interest rate. So that's what you do at the very beginning. Once you've done that, you can adjust the lease carrying amount for the principal reduction, and that would be the amount of the lease payment less the interest expense. That equals the principal reduction. You use that principal reduction to then reduce the amount of the lease liability, and that amount of reduced lease liability is what you're going to be using to calculate the next year's interest expense, and it goes on like that. So again, you adjust the lease carrying amount for the principal reduction to calculate interest for subsequent years. And so you just keep doing that over and over again. But we didn't go too much into that because I just wanted to show you how to calculate interest expense in general. And with all that, we've gone over the pillar topics for this video, and that is everything for this YouTube version of the video. Again, remember, we only went over 5 questions, but Superfast CPA Pro members will get access to the full 10-question video that I'm about to finish recording right after this, and they will get a little bit more practice, a little bit more understanding, and a little bit more teaching. So if you like this and you like our other material, make sure you check out becoming a Superfast CPA Pro member, and the easiest way to do that is by first going to our Superfast CPA training webinar. It's only 1 hour, it's free, and we will teach you how to pass the CPA exam without wasting months or even years of your time. And after you watch that, it will be easier to then learn about the pro course, and then you'll become a Superfast CPA Pro member and you'll be able to access all these awesome materials. I hope this was all helpful, and if you liked the video, make sure to like it and leave a comment, and I will see you in the next video.